Welcome to another episode of Life Insurance Exposed, where we cut through all the BS and show you the fine print that your life insurance agent doesn't want you to see. My name is Jonathan Aguilera, and today we're breaking down indexed universal life insurance cap rates. But before we do that, thank you for the 200 subscribers that we just got over the last couple of days. That's a big deal. So thank you. They say you can get upside potential with downside protection. They say you can get market-like returns because it mirrors the S&P 500. And they say you can never lose money when the market crashes like 2008, the scare tactics. Or what about these ones? It's better to have an indexing strategy so you compound where you left off, because remember, you have a zero floor and that it's a tax-free retirement via loans. Does any of this sound familiar? That's exactly what your IUL agent probably pitched you. So what we're gonna do, we're gonna take it all the way back to 1997 when IUL started, and you can see how the cap is the trap. So what we have here is the S&P 500 total return on the left, and we have the S&P 500 price return on the right. This is extremely important to understand the difference between the two. So the S&P 500 total return versus the price return, what do you think the biggest difference is here? The S&P 500 total return has dividends reinvested. And for those of you guys that don't know, 30 to about 40% of the S&P 500's total return comes from dividends reinvested. Okay, so the S&P 500 price return does not have any dividends reinvested. So if we were to take a look back at 1997, on the total return, it did positive 33%. But if we were to look at the price return, do you see how it only did 31%? That is the difference. And you're going to see how big of a difference that makes long range through compound interest. So we have an initial investment of $10,000 both. Okay. I also want to show you guys one more thing. Okay. If you were to look at the negative years, so in 2000, we did negative 9%, but on the price return, we did negative 10%. So on good years, the S&P 500 total return does better than the price return. And then on negative years, the S&P 500 total return doesn't do as bad as a price return, as you guys can see right there. I'm going to show you guys another example. Back in 2011, the S&P 500 total return did 2% return. That was a positive return, but the price return returned 0. Okay. I want you to think about how important that is, because I'm going to come full circle with this right now. So from 1997 to 2026, so that was as of last month, okay? The S&P 500 has returned $158,000. So that $10,000 initial investment today would be worth $158,000, and we got an internal rate of return of 9.95. And if you're wondering how we calculate the internal rate of return, make sure you go ahead and watch our internal rate of return video on whole life insurance so you guys can get dialed in on that sucker. If we were to look at the price return, that same $10,000 investment, that's almost $60,000 difference. And we have an internal rate of return of a little under 8%. I hope you guys are understanding how big of a difference this is. So, what do you think your indexed universal life insurance policy tracks or mirrors? It's definitely not mirroring the S&P 500 total return. It is mirroring the S&P 500 price return. Your indexed universal life insurance policies do not get dividends reinvested. That means you're tracking an inferior way to get credit to your life insurance policy. Now, I know some of you guys are probably flabbergasted and discombobulated that your IULs don't get dividends reinvested. I know it's a tragedy. Well, it's about to get worse. Imagine what happens when you put a cap rate on your growth, on your compound interest. But before we do that, make sure you hit that like button, you subscribe, and you leave a comment so this information can get pushed out to the algorithm. So back to our spreadsheet. So in our next scenario, I'm showing an IUL with a 12% cap rate. Guys, that's high, by the way. That's really high. And if you don't understand the cap rates, go back to my previous video where I break down Nationwide's cap rate integrity. And that's all insurance carriers, by the way. All insurance carriers are going to lower cap rates. So all I did was the same 10,000. I got the same returns from the price return. 31, 31, 26, 26. And you guys can pause this so you guys can fact check me. So on the growth, if I just double tap that, I did 12%. We're just getting 12% interest, okay? Because you can't get the whole 31%. You're capped. And I just did 12% through the entire scenario. So if we go all the way down, we get an internal rate of 7.71 versus 7.98. So the price return gave us 93,000. That 10 grand grew to 93,000 with our IUL 87,000. But if we went directly to the S&P 500 total return like we're supposed to invest, it's 158,000. So you're behind. You're behind, okay? I even took it a step further. I did an IUL with a cap rate of 12, and after 5 years, we get a cap rate change and they lower it to 8% because guys, that's real. They're going to do that. So I'm just simulating this stuff. So 1, 2, 3, 4, 5. So we get a positive credit here. And if you can see, I changed it to 8%. 8%. Okay. If we were to scroll all the way down, our internal rate of return has now dropped to 7.31, right? At 78,000 would be your cash value, okay? Then I took it a step further, okay? Start with a 12% cap rate. After 5 years, drops to 8. After another 5 years, so on year 10, they drop it to 6. Guys, I am not exaggerating with this stuff. I have in-force policies from clients that I've replaced and I've helped with cap rates of like 4, 4.5, 5, 6, 7. So this is not uncommon. So on year 6, so that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So it will be right here when they get a 6% credit. Yep, 6%. Okay. So if we scroll all the way down, our internal rate of return goes to 7.10. And I need to stress something. This is without fees. This is without cost of insurance, administrative charges, premium expense charges, load charges. That is a gross number, guys, a gross number. I need you guys to really make sure you understand that that's not real. So if we were to take into consideration the cost of insurance, we're probably netting maybe 4 or 5% ish, depending. And then our final example, if we went straight to an ETF, because we wouldn't just go into the S&P 500, we would have to buy like an ETF or a mutual fund. So SPY is the Spider Trust Fund S&P 500 ETF, and it has an expense ratio of 0.9%. Now, one of the things you guys need to understand is that internal rates of return take into consideration all fees. It's your net cost. It's your net return. It's net, net, net. So I want to go back to the market change. If you notice, remember, we're tracking the S&P 500 total return. SPY returned 33.32%. If we were to look at the total return, 33.36. Okay. Why did SPY return a little bit less? Because of that 0.09 expense ratio. So this is the net return. That's what you actually got. So that same $10,000, right, invested into the S&P 500 and ETF, if we were to scroll all the way down, we're getting 10.11%. It's $166,000 account value that $10,000 would have grown to versus, okay, 73,000 in your IUL. It'd probably be a lot lower than that, okay? or 78,000, or I mean, this is like best case scenario, $87,000. Guys, this is a no-brainer. I've been screaming this from the mountaintops that index universal life insurance policies will never get market-like returns. The truth is simple, guys. The cap is the trap. Reduction of your cap rates and the rising cost of insurance will always be the Achilles heel of every single IUL. You're never in control of your cap rate. The insurance carrier can lower them whenever they feel like it. So if anybody ever told you that your IUL can give you upside potential with market-like returns, well, you just saw the math that disproves the lies that these agents tell you. At best, and when I mean at best, max funded, properly structured IULs with a minimum death benefit will get bond-like returns. But the reality is 99% of all IULs sold in today's marketplace, they're not properly structured. They're not max funded. And you know what that means? That they're not going to receive the crediting that the policy needs. The cost of insurance is going to go through the roof, eroding your cash value. And I see this time and time again. Lapse. If you have an IUL and you want to know whether your cap rates have reduced or if it's performing as illustrated, click the link in the description and I get you a free policy review. If you found value in this video, make sure you subscribe to the channel. This is Life Insurance Exposed. I'm Jonathan Aguilera, and I'll see you on the next episode.